Ready to dive into something that, on the surface, might seem a little dry, but I have a feeling it's actually full of juicy history.
I think you might be right.
We're talking interest rates.
Ah, the price of time itself. And you've brought some excerpts from Edward Chancellor's The Price of Time for us to dig into.
Yeah, and this isn't just some theoretical deep dive. This is about uncovering how the cost of money has driven booms and busts and even shaped entire economic systems. Okay, so interest rates. On the surface, kind of boring, right?
Yeah.
But I have a feeling there's more to it than meets the eye. Where do we even begin to unravel this?
Well, the concept of interest itself has always been a bit, well, contentious.
In what way?
Many viewed it as exploitative. We're talking about a practice that dates back to ancient Mesopotamia, where exorbitant interest rates, we're talking crazy high, could cost people their land,
Wow.
even their freedom.
Talk about high-stakes lending.
Right.
So, from the start, it's about more than just money. It's about power dynamics, too.
Absolutely. And this tension, this back and forth around interest, didn't disappear with the ancient world. Fast forward to Karl Marx in the 19th century, and you see him railing against interest, calling it usurer's capital, claiming that it kept the working class essentially trapped in poverty.
Interest as a tool of oppression. I can see why this topic has sparked debate for literally centuries.
Yeah.
Is this debate still going on today, would you say?
Oh, absolutely. It's still very much alive. Just look at 2013, the Archbishop of Canterbury. He condemned payday lenders,
Really?
waging a war, you could say, against predatory lending practices.
Okay, so that's a pretty strong stance. But people need loans for all sorts of reasons. It can't be all bad all the time.
You're right. It's not so black and white. We have to consider what we call time preference.
Okay, break that down for me.
Simply put, people value immediate gratification over future rewards.
Okay, so that's like choosing, I don't know, one cookie now over two cookies later, even if you know that waiting means more cookies in the long run.
Precisely. That's a great way to put it. And this time preference, it's woven into how we lend and borrow. Think about needing like $20 before payday. You might be willing to pay a premium for that immediate cash.
Because having it now is more valuable than waiting.
Exactly, even if it means paying a higher cost in the end.
Right. So you're putting essentially a price on impatience, making it like a quantifiable factor in financial decisions.
Exactly. And while some argue that charging any interest is inherently wrong, morally wrong, this time preference is a basic human trait.
Yeah.
And it influences financial decisions in a very real way.
That's a really interesting way to look at it. So we've got this sort of built-in tension around interest. But how has that played out on a larger scale throughout history? Have things always been this complicated?
Oh, not at all. History is full of cautionary tales
No.
about interest rates gone wild.
Okay.
One particularly striking example, John Law's Mississippi Scheme, 18th century France.
I've heard whispers about this.
Yeah.
Wasn't it a complete disaster? Like a cautionary tale for the ages?
A spectacular collapse is putting it mildly.
Okay, so who was this John Law and what was his scheme all about?
So John Law was this Scottish financier who convinced the French government to let him start a national bank.
Okay.
To print paper money and supposedly use it to, supercharge the economy.
Sounds almost too good to be true. I'm sure there's some catches along the way. What went wrong?
Well, one of Law's goals was to drastically lower interest rates, and initially it worked. Loan rates plummeted.
To what? How low are we talking?
To a ridiculously low 2%.
2%.
2%.
This sounds eerily similar to what we were just discussing about the dangers of artificially low rates.
Right.
Were there any warning signs, any cracks in this facade of prosperity?
You hit the nail on the head. See, this flood of cheap money, combined with Law's involvement with the Mississippi Company, think of it as like the hottest stock in 18th century France.
Okay.
Well, this created a breeding ground for a speculative bubble.
So everyone wanted a piece of the action.
Exactly.
Borrowing heavily to get in on what they thought was the ground floor.
The price of Mississippi Company shares, they skyrocketed. People thought they'd found the secret to instant riches. But when some investors tried to cash out, exchange their shares for something tangible,
Yeah.
it triggered a chain reaction.
Uh-oh.
The bubble burst, share prices crashed, and France plunged into, you guessed it, an economic crisis.
It's incredible how these historical patterns repeat themselves. You'd think we would learn from the past.
You would think, wouldn't you? But the allure of easy money and get-rich-quick schemes...
Timeless.
Absolutely timeless. And the Mississippi Scheme, well, that's not an isolated incident. Let's fast forward to the Gilded Age, late 19th century. Another period of falling interest rates, speculation. We saw the rise of figures like Rockefeller.
Ah, the era of robber barons. What were the similarities between this period and what happened in 18th century France?
Both situations saw this perfect storm of falling interest rates and speculative investments. Like clockwork, we see a familiar pattern emerge. Risky investments, this concentration of wealth at the top, and eventually a correction that leaves many worse off.
So what you're saying is that while low interest rates might seem appealing on the surface, they can also create instability and potentially lead to disaster.
Precisely. It's about finding a balance. Low rates can stimulate economic growth, but if they stay low for too long, well, they can incentivize reckless borrowing
Right.
and create unsustainable bubbles, which, as we've seen, never end well.
That makes a lot of sense. So we've covered the historical tensions surrounding interest, and we dove into some, well, fascinating yet messy examples. But how does the story of interest rates evolve as we move into the 20th century? I'm guessing the creation of the Federal Reserve didn't magically solve all our problems.
If only it were that simple. The Fed, tasked with managing interest rates, stabilizing the economy, well, let's just say they've had their share of wins and learning experiences.
That's one way to put it. So how did the Fed's actions, or maybe inactions, contribute to some of the biggest economic upheavals of the 20th century?
Such as?
Well, we're talking about the Roaring Twenties, the Great Depression.
You got it. And to fully grasp this, we need to bring in two giants of economic thought, Friedrich Hayek
Okay.
and John Maynard Keynes.
Big names.
Big names, big ideas. Their contrasting views on interest rates and economic cycles, I mean, they're debated to this day. But before we get into that, let's rewind. Back to the Roaring Twenties. The Roaring Twenties, a time of economic boom, yeah, but like we often see, a time when trouble was brewing beneath the surface. The Fed, their aim was to maintain this growth, right? So they kept interest rates artificially low.
So similar to the historical examples we were just talking about, this cheap money fueled a frenzy of spending and speculation.
Exactly. The stock market soared, fueled by margin loans.
Which are basically,
Essentially borrowing money to buy more stock.
oh, cut.
All built on this belief that the good times, they were going to last forever.
And then, of course, came the crash of 1929, ushering in the Great Depression. Did the Fed's low-interest policies, did they play a role in this disaster?
Well, the Great Depression's causes are complex,
Right.
but many economists, including Hayek, they argue that the artificially low rates of the 1920s, they contributed to an unsustainable boom, and that inevitably led to a bust.
So Hayek believed that keeping interest rates artificially low, it distorted natural market signals,
Yeah.
resulting in what economists call malinvestment.
That's right. Hayek argued that when interest rates are pushed below their natural rate, businesses, they're tricked into making investments that would be honestly unprofitable under normal circumstances. And this misallocation of capital, it creates this fragile economic foundation.
Like building a house on sand.
Exactly.
It might look okay for a while, but it's bound to collapse eventually. So how did King's view differ from Hayek's in this scenario?
Well, Keynes was less concerned with the potential distortions of low rates
Okay.
and more focused on using them to combat unemployment, to stimulate demand,
Okay.
even if it meant government spending more than they took in.
So in a way, Keynes advocated for a more active role for the government in managing the economy,
Yeah.
while Hayek leaned towards a more hands-off approach.
That's a good way to put it. And it's a debate that honestly continues to resonate today, especially in light of more recent economic events.
This makes me think about the period leading up to the 2008 financial crisis.
Yeah.
Didn't we see a similar situation where low interest rates seemingly fueled a bubble?
You are exactly right. The 2008 crisis was, in many ways, a stark reminder of the potential consequences of relying too heavily on low interest rates to drive economic growth.
Can you elaborate on how low interest rates contributed to the 2008 crisis?
Sure. During the early 2000s, there was this widespread belief that we had entered this era of great moderation, this period of sustained economic stability. But this stability, it was built on a foundation of easy credit and these complex financial products, particularly in the housing market.
Subprime mortgages.
Remember those?
How could we forget?
Right.
Weren't those the loans granted to borrowers with, poor credit?
Mm-hmm.
And often with very little documentation? It seemed like almost anyone could get a mortgage.
That's right. And these risky mortgages, they were bundled together. And then they were sold off as mortgage-backed securities.
Okay.
Wall Street. They love these things Because they promised higher returns than traditional bonds.
At least on paper.
At least on paper, right.
Right.
So investors, enticed by this prospect of higher yields, they piled into these mortgage-backed securities, assuming the housing market, this upward trajectory, it would continue.
And as long as interest rates remain low, masking the underlying risk, the party could continue.
Exactly.
But when the Fed started raising rates in the mid-2000s,
The music stopped.
and that's when the house of cards began to crumble.
Exactly. Subprime borrowers, they're faced with rising monthly payments, and they begin to default on their mortgages. The value of those mortgage-backed securities plummeted,
Wow.
sending shockwaves throughout the global financial system.
It's a stark reminder that seemingly small changes in something as fundamental as interest rates can have far-reaching and devastating consequences.
Absolutely. It highlights that crucial point that artificially low interest rates, whether they're engineered by a central bank or a government, they can create this dangerous illusion of prosperity, all while masking these deeper systemic risks.
This brings to mind the case of China. I mean, they've experienced this remarkable economic growth for decades, and part of their strategy has involved maintaining these artificially low interest rates. But as we've seen, this approach can create significant risks. Tell me more about China's approach.
China's economic rise is a fascinating case study. It's what economists call financial repression. And this strategy, it involves keeping interest rates artificially low, right? But it's to fuel borrowing and investment,
Oh.
often at the expense of savers.
This financial repression strategy, it seems like walking a tightrope.
Yeah.
What are the potential long-term costs and benefits of, manipulating interest rates to this extent?
That's the million-dollar question, isn't it? China's government, they've maintained this tight grip on their banking system, setting interest rates well below market levels. And this has enabled Chinese companies to borrow heavily, to invest aggressively, fueling the country's rapid economic growth.
But could this approach backfire? What are the potential risks associated with this strategy?
There are inherent risks. China's reliance on financial repression, while it's been successful in the short term, has led to this explosion in debt levels,
Wow.
raising concerns about the long-term health of their financial system. Some economists, they even suggest that China's economic miracle, it might be built on a foundation of unsustainable debt.
It seems like we see a pattern here, this recurring theme of artificially suppressed interest rates leading to hidden risks and this potential instability. But how does this all connect to our current situation? We're living in an era of these soaring asset prices, from stocks and real estate to even like cryptocurrencies and even like vintage cars.
Yeah.
It feels like we're in the midst of this everything bubble.
You've hit on a critical point. This everything bubble that we find ourselves in, it's in many ways another consequence of this low interest rate environment we've been discussing. When the cost of borrowing money is incredibly low, as it has been for over a decade, investors, they're incentivized to take on more risk in pursuit of any yield, however small, above those rock bottom rates.
This makes sense. If traditional savings accounts and bonds offer minimal returns, investors are going to look for opportunities elsewhere, even if it means taking on more risk. But doesn't this create this dangerous feedback loop where this easy money just fuels asset bubbles?
That's exactly right. This chase for yield, fueled by these low interest rates, pushes asset prices higher and higher. But as history has shown us time and again, these situations, they're inherently unstable.
So then what happens when this low interest environment changes?
That is the billion-dollar question. History teaches us that these bubbles, they eventually deflate, sometimes gradually, sometimes catastrophically. The challenge is navigating that inevitable correction in a way that minimizes the damage to the broader economy.
And that's the million-dollar question for another day, I suppose. We've covered a lot of ground in this deep dive, from the ancient origins of interest to the, precarious state of our current financial system. What's the key takeaway you want our listeners to walk away with?
Interest rates, they're much more than just numbers. They're powerful forces that influence our decisions, shape our economies, and really impact our lives in countless ways. Understanding this interconnectedness, it's crucial, especially as we navigate this increasingly complex and uncertain financial landscape.
That's a great point to end on. To our listeners, the next time you hear about interest rate hikes or market fluctuations, remember, it's not just about economics. It's about history, power dynamics, and ultimately the future we're all creating. It feels like we're living in, a financial funhouse or something. Everything's gotten more expensive.
Right.
And it seems like these ultra-low interest rates we were talking about are kind of the culprit here. But what does this everything bubble, as we're calling it, What does it actually mean for, for the average person who's just trying to make ends meet?
Well, that's the thing, isn't it? It's a double-edged sword in a way. On one hand, low rates make it cheaper to borrow money for those big
Like
purchases.
a house.
Exactly, a home, a car. But on the flip side, saving for the future becomes so much harder. Your money, it just sits there in a savings account, earning practically zero interest.
It's like we're being told to spend now and worry about the future later, not exactly, a sustainable long-term strategy.
You got it. And it's especially tough on retirees, people who are relying on, fixed income from their savings. Low interest rates, they translate to these paltry returns on their investments.
Yeah.
And it makes it so much more difficult for them to just, maintain their living standards.
So are we sacrificing the future for this short-term economic boost? It feels like there's this disconnect between, encouraging spending today, but then also ensuring financial security tomorrow.
It's a tough balancing act for sure. Policymakers, they face these tough choices. And those choices have very real-world consequences. But going back to your point about this everything bubble, let's think about what happens when interest rates inevitably rise.
That's what I'm worried about. I mean, we've seen what happens when bubbles burst. It's rarely pretty.
Right?
What's the likely fallout this time around?
Well, when rates increase, investors, they tend to pull back from those riskier assets, those, highly valued tech companies. What do they call them? The unicorns.
Right, with the billion-dollar valuations.
Yeah, with billion-dollar valuations, but minimal profits.
Yeah.
They become particularly vulnerable.
Because their whole model hinges on this assumption of cheap, readily available debt.
Exactly.
So what happens when that dries up?
They'd either have to figure out how to become profitable, like fast,
Hmm.
or they face the music. And let's not forget about this whole cryptocurrency craze.
Right.
Bitcoin, Ethereum, it's a speculative frenzy fueled by the same low interest rate environment.
It's like a high-stakes game where the rules are constantly changing.
Right.
So we've got this everything bubble that's been inflated by these ultra-low rates. Where do we go from here?
That, my friend, is the trillion-dollar question. If history has taught us anything, it's that these bubbles, they eventually deflate, sometimes gradually, sometimes catastrophically. The real challenge, though, it's navigating that inevitable correction in a way that minimizes the damage to, well, the broader economy.
Right, right. It's definitely a lot to think about. And I think we've covered so much ground in this deep dive, from the ancient origins of interest all the way to the, well, let's call it the precarious state of our current financial system. As we wrap up here, what's the key takeaway you want our listeners to really walk away with?
Interest rates, they're more than just these abstract numbers. They're powerful forces that they influence our everyday decisions, they shape our economies, and they impact our lives, honestly, in countless ways. Understanding this interconnectedness, I think, it's crucial, especially as we try to navigate this increasingly complex and uncertain financial landscape.
That is a great point to end on. To our listeners, the next time that you hear about interest rate hikes or market fluctuations, just remember, it's not just about economics, right? It's about history.
Mhm.
It's about power dynamics. And ultimately, it's about the future that we're all creating together.